let's turn to our fourth surprise, and we're going back to Singapore with you, Ishreth. Now, you have quite an extreme view. You think that one of the surprises for 2024 is that the oil price could be over $150. Now, it's sitting around the $80 mark at the moment. That sounds pretty scary, although actually when I looked at the history, we forget that oil prices were close to $150 around 2008. So perhaps it's not as outlandish as it initially seems. So first of all, I think it's important to ask, what probability are you assigning to this? And if you could just take us through your thinking on that.
Sure. I mean, as you alluded to earlier, Linda, oil at 150 is not necessarily a base case, but is a scenario that's widely underappreciated by the market today. I'd say there's at least a 20-30% chance that oil could be above 150 by the end of next year. More importantly, should this happen, it'll have a profound impact across all sectors and markets. So it's something that we definitely need to be prepared for, particularly given the current setup. It all boils down to good old supply and demand, with supply being the key piece of the puzzle in this case. And if you look at what's happened over the past 10 years, capital investment into new supply of oil and gas has shrunk dramatically for various reasons. In fact, aggregate capex for energy companies adjusted for GDP is at its most depressed level over the past 30 plus years, and 75% below its peak in 2014. What this means is that existing oil and gas fields start depleting quite materially going forward by, say, 7% annually for oil and 5% annually for gas. At the same time, demand will only continue to rise because energy and hydrocarbon intensity are still growing across more than 75% of the global population, where prosperity is still rising. And renewables are nowhere close to satisfying this gap in the short to medium term. Inflation and high interest rates have only exacerbated the problem. Renewable projects were already unprofitable and needed to be heavily subsidized to grow adoption in the past. And with the cost of capital now increasing so dramatically over the past year alone, they've become even less viable today. And one simply just needs to look at the old renewable stock darlings like, say, Plug Power for green hydrogen, or Ørsted for offshore wind, or Solar Edge in the solar space to understand the extent of this problem. With rising rates, all these stocks have basically collapsed 80-90% from their peak due to waning demand and massive losses on their order books. All this doesn't even take into account geopolitics. Just take a look at the largest oil producers globally. If you combine the two biggest producers from Russia, they become larger than Saudi's Aramco. And to match Russia's supply, you need to combine the next 5 biggest Western energy giants, including, say, Exxon, Shell, Chevron, BP, and Total together, which is a staggering problem. Imagine if there was an actual and sustained supply disruption from any of these precarious regions like, say, Saudi, Iran, Iraq, Russia, which seems more likely than ever today. In that scenario, $150 oil may actually be conservative. And to bring this all back to stocks, let's consider the valuation of energy companies. They're the cheapest they've been in decades, with exceptional balance sheets. And if energy prices go up, they only become cheaper. Today's consumer discretionary sector is now worth more than 2.5 times the energy sector. But the latter generates more than 5 times the free cash flow of a consumer. Consumer tech in the US is sexy, while oil and gas is not. But at $150 oil, that could very easily reverse. And that's something that we and our investors must be acutely aware of.
So, Ishreth, this sounds like a bit of a bet on old energy. Obviously, new energy has been very much talked about, very much the flavor of the day. Does that conflict with some of the comments earlier about the materials exposure in the global funds that is more renewable energy focused?
Well, not necessarily. So even though the new energy complex is not growing as fast as it need to fill the gap, doesn't mean that it's not growing. So trends like the move to renewables and electrification will continue at a very rapid pace over the next few years, just not fast enough to match the demand for it. The type of businesses that we have exposure to are directly exposed to areas of the market where there's going to be supply shortages, so say like lithium or copper, and we're exposed to the lowest cost producers there. And those who know Foord also know that we never make 0-1 bets. And this is a case of that as well. So regardless of how the energy mix evolves, we are positioned our portfolios to benefit from it. So if it's oil and gas, we'll have businesses that work well in that scenario. And if renewables continue to compound as we believe they will over time, then we own stocks that would work under that context as well.
Okay, well, Rashad, thinking about an oil price over $150, I mean, if you consider the impact of oil prices on the South African economy, along with many other economies around the world, and the impact on headline inflation, the interest rate hikes that followed, $150 oil would surely be pretty awful for the South African economy. What do you think the impact of that would be on us here at the tip of Africa?
Yeah, we're a big oil importer, so that will be negative for terms of trade. So you could expect the rand to depreciate significantly in that type of scenario. And higher oil price is also a tax on the consumer, so you can see a drag to GDP growth. And also with higher oil prices, you're looking at high inflation and potentially interest rate hikes. So all in all, a pretty bad scenario for the South African economy. You're not going to get the growth recovery that we're expecting. So we have to take that into account, but we won't be alone. I think if you see $150 oil, that would be a big drag on on the entire global economy.